All right, so Kamala Harris recently endorsed Biden's budget proposal, which lends credence to the notion that I think that Kamala's administration will probably just be a continuation of the Biden administration and their plans. Maybe there'll be some differences. We'll see as the campaigning continues, or, she gets elected and then you can actually see what the administration does. But I did actually want to see what the things are in that budget proposal. And then I was looking and I was like, this budget proposal is 188 pages. There's no way I'm reading all that. And I only care about like the specific like tax code changes things. Right now, like this video is going to be like my most uneducated take on all of this because one, I don't know all the different forms of taxes we're talking about when the proposals are going, and then two is that I don't have a good understanding of what things do what. So this is going to be like my initial ignorant take on everything, and then my plan is to read a bunch of like books on economics and shit so then I can be like, okay, what's actually good, what's actually bad here in terms of taxation policy. I want to know more about taxation policy so then I'm not just like um, tax higher income people equals always a good thing. We need to tax the rich, that sort of thing. Like, I don't know. I'm 23 now, and it's become clear to me that certain things are just like talking points for sides, and I'm like, okay, what's actually proper policy decision that is appropriate to make the lives of people better, and figuring that out. So that's what I'm going to try to educate myself on in terms of like actually learning how economics policy works, how economics works, and then how the policy around economics should be based on that. So, because I don't know anything about this tax foundation. Apparently, they're a nonpartisan nonprofit organization that does a bunch of research on tax stuff in America, or tax foundation. But they've also got a Europe thing, so maybe they do other stuff too. But they seem like an interesting resource to talk about this. Apparently, they did this article where they modeled, in theory, if you were to implement these tax policies, and it seems negative. But again, I need to actually understand tax stuff in order to know for sure. So my plan is to read some economics books so that I get a better sense of like macro econ concepts, because right now I don't have a good clue. But for now, we're going to give my initial take on some of these proposals. So business proposals to increase the corporate tax rate from 21% to 28%. I forget what it was pre-Trump tax cuts. Trump corporate tax cuts, because I think it was like 23% before he cut them. Da, 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 da. Corporate tax. What cut? No, that just tells me I want to know the percent, not how much more money they made, which I guess I can get the percent from that, but that's annoying. Uh tax cut was, oh, it was 35%, and then they made it 21%. So yeah, that's not even back to the 35% high that it was at. So if things weren't terrible while it was 35%, like I don't know, because my understanding is that corporate tax rate is tax on the profit of your corporation, corporate taxes. Because I know a lot of small businesses, what'll happen is they'll buy up a bunch of stuff, so then they make less of a profit. Not even small businesses, big businesses do this. Direct tax levied on income or capital of corporations, but where was it taxed on? Profit? Purpose of corporate tax is to generate revenue for the government by taxing the profits earned by corporations. Yeah. So it's taxed on profit. So the notion was that, oh, if we do a corporate tax cut, then that means the corporation will be able to have a higher amount of profit, and that profit they'll use to invest more in their business. And that doesn't actually make sense, because if they get more profit, they'll just pocket the money, because if they're getting taxed more, that actually incentivizes them to be like, hey, we should get less profit so that we don't get taxed on that profit. So that encourages you to spend more of your money. And then how are you going to spend that money? Obviously, you're going to spend that money on like investing in your company. So I think it's the opposite thing, that a higher tax rate would force you to invest more in your company uh, rather than the other way around. Whereas just making profit, like, what are you gonna, like, once you've made the profit, you can literally just pocket that. You can do anything with the profit. So that's my understanding there. Now, based on this thing, it says that, based on their modeling, they're like, oh, you lose a bunch of jobs. No, not that table. Which table is the one? That's for individuals. Where's the business table? Detail table 2. Oh wait, corporate taxes is here. Yeah, apparently you lose a bunch of jobs if you do that. And I'm like, how? What's the mechanism for that? So basically, this video is just going to be like all of my questions. And then I'm going to try to figure out what the answers to said questions are by reading more economic stuff. And maybe I can like ask an economist or something, because I don't know. And then but they literally have economists that wrote this, so I don't know. I need to understand how the modeling worked for that, for them to determine that, oh, these are not bad. These lose you almost over 500,000 jobs will be lost, lower wages, lower GDP, and all that stuff. So I have no clue. And then next thing is increased corporate alternative minimum introduced in. I don't know what alternative minimum tax means here. Like was the normal rate this, and then the alternative minimum, like what is that? Alternative minimum. Alternative minimum tax. IRS. Let's go. We're researching this on the fly. This was introduced in the Inflation Reduction Act. The Inflation Reduction Act created the Corporate Alternative Minimum Tax, which imposes a 15% minimum tax on adjusted financial statement income of large corporations for taxable. This means they're not being taxed on profit. They're just being taxed on income. This is like tax on revenue, like a minimum tax. Is that how that works? Generally applies to large corporations with average annual fiscal statement exceeding 1 billion. So if you're a big corpo, you have to pay tax on revenue? Is that what that means? Because fiscal statement income, adjusted fiscal statement income. Let's see, what is that? Adjusted fiscal state income, because that seems kind of stupid, to be honest. For purposes of this part, the term adjusted fiscal statement income means, with respect to any corporation for any taxable year, the net income or loss of the taxpayer set forth on taxpayers' applicable financial statement for such taxable year. So, okay, let me make sure that I understand, because it says net income or loss, but means with respect to any taxable year, an applicable financial statement as defined in section appropriate adjustments. Oh my god. I feel very stupid here, because I don't know whether or not, because if it says net income or loss, then that means profit. That means but if they already increased the corporate tax rate, how do you get the alternative? Generally applies to large corporations. Does that mean that you're at 21% until you're exceeding 1 billion, then you get to be 15%? Like what is that? How's that actually work in practice? Corporate tax deduction. Corporate tax. Federal corporate tax rate 21% applies to corporate tax. Or even if you get all your deductions and stuff, you still have to pay 15%. What are we talking about here? How does that 15% apply? I don't understand. CMT. I don't know. How do you get that? how corporate. Does Wikipedia have something on this alternative? The corporate alternative minimum tax was also. Oh, okay. So that had existed before. Then we reinstated it with the Inflation Reduction Act. So Trump got rid of that. But what does it do? Alternative minimum tax is a tax imposed by the U.S. federal government in addition to regular income tax. In addition to regular income tax for certain individuals. What? Alternative minimum taxable income by taking ordinary income and adding disallowed items and credits such as state, local tax. Oh, is that how it works for corporations too? I don't, because this is talking about for income in general. So if they get all their deductions and stuff, you still have to pay 15% on like net everything. So it's 21%. What? How's that? How's that actually work? Alternative minimum tax calculation. 26% tax rate on the what do you I should not read this right now. This is not the time to read this right now. Okay. Literally my okay. I'm not going to figure it out in this time period or without many more hours of research rather than just looking at that. Okay. So I don't know how this applies. Like once you get your 21% tax on your profit, how's that 15% come into the picture is what I'm not sure about. Longer. Okay. Okay. Okay, let's see other things in the budget proposal because we're not going to figure that out. Quadruple. Oh well, I'm not going to figure this out either. Stock buyback tax. So stock buyback is when a company buys its own stock because when the company buys its own stock back, then it artificially inflates the price of its stock because that means that there's less of its stock on the market. So, you're decreasing the supply with the same demand. So, therefore, the price increases. I'm pretty sure that's why stock buybacks exist. It's I don't know why we're allowed to do that because it seems like why are you able to like artificially increase the value of your stock like that? But anyway, once you do that, instead of it being 1%, it's 4%. I don't see that as a major negative, to be honest, because okay, it might how much does that disincentivize doing the stock buyback? Because if you do a stock buyback and you decrease the supply of your stock so that it inflates the price, then before you do the buyback, a lot of people will buy your stock and that will be better for your market cap. And I believe that your market, let me think. Shoot. I don't think I have a good understanding of like how investor money goes to the company so that the company can use that money. Because I know that you can take loans out on your company because your market cap is high, and then you can be like, oh, look, there's so much investment in our company, therefore we need this money, so then we can use it to invest in ourselves, and da 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 da. You can do that sort of negotiation. But how does, if I own stock in a company, how can the company use that money that I paid to own part of their company? I don't actually know how that goes. Is it just fundraising? Is it similar to fundraising? I have no clue how the money like that works. I need to. Oh my god, I'm figuring out so much stuff that I don't know about how money works. Great. Okay. Next thing is make permanent excess business loss limitation for pass-through businesses. I don't know what a pass-through business is. Oh my god, there's so many terms in here. Pass-through business. This is from the Tax Foundation that I'm reading. Pass-through business. Pass-through businesses are the dominant business structure in America. Pass-throughs file more tax returns and report more business income than C corporations. What's a C corporation? Oh my god. Pass-through businesses are not subject to corporate income tax, but instead report their income on the individual income tax. Oh, okay. Okay, so it's like a small enough business that it's basically functions similar to an individual tax return of its of owners. Okay. In pass-through business earned profit, it does not directly send a portion of profits to the IRS. Instead, the profit is passed through the business and onto the tax returns of the business owners. So yeah. Your revenue ends up being distributed to the owners and then taxes regular individual stuff instead of just like a corporate entity. It's probably something like that. Which face two layers of taxes. Yeah, one at the corporate level, one at the shareholder level. Pass-through businesses face only one layer of taxation paid by the business owner. Okay. Okay. So what is this proposal? Uh, Permanent excess business loss limitation. What the hell is this? What the hell? Oh my god, I have to look up everything. Excess business losses. Non-corporate taxpayer may be subject to excess business loss limitations. The at-risk limits and passive activity limits are applied before calculating the amount of any excess business loss. So if you have a net loss in your business, what happens? An excess business loss is the amount by which the total deductions attribute to all of your trades or businesses. Attributable to all of your trades or businesses exceed your total gross income and gains attributable to those trades or okay. So you're able to make enough deductions and stuff that your gross income that's above your gross income, so then you have a net negative income from that. Threshold amounts are I'm probably misinterpreting this. Oh my god. Uh, okay. Okay. I don't know what this did. I don't know what the benefit of being able to like now you can have excess losses. Does that mean the government pays you? I don't know. I don't know. Or you just don't pay taxes because you made a loss. But anyway, further limit the deductibility of employee compensation under section. Okay, so I'm assuming, yeah, they used to be able to deduct employee compensation, so now you can't do that as much. So if you paid your employees more, then you can pay less in taxes on your payroll. I'm assuming that's something like that. Increase global okay, I don't understand anything about global taxes. Oh my god, I have no clue what the hell this is. Global intangible low tax income. Does that mean if I have an employee that's outside the country, I'm just assuming what this means. I have no idea. If I have an employee in my global business that's outside the country, then I pay taxes on their payroll. Global intangible low income is a category of income that is earned abroad by U.S. controlled foreign corporations and is subject to special treatment. Yeah. So if you're a U.S. corporation but you do stuff internationally, this is where that tax applies. But how does it apply? The U.S. tax is intended to prevent erosion of the U.S. tax base by discouraging multinational companies from shifting their profits on easily moved assets such as intellectual property. Before the enactment of the Tax Cut and Jobs Act in 2017, that's the freaking Trump bill, U.S. businesses and individuals were subject to U.S. income taxes on their worldwide income, but income earned by the foreign subsidiaries of U.S. was subject to tax only when repatriated to the U.S. as dividends. this change the rules for national companies by generally exempting earnings of foreign subsidies, active businesses from corporate transaction, even if repatriate. Okay, so they just don't get taxed if they're outside the U.S. Oh, okay. Is income earned abroad by control? Yeah, okay. So they're increase. Yeah, so okay. So yeah, if they have international income that's taxed less than normal corporate taxes. But Biden administration wants to increase that. But how does this even end up applying? Like, because I just read that if it's repatriated to the United States, they still don't pay the tax. So how does this work? Is it just a moot tax now? Like what? Uh, Although the lower the top corporate tax rate, the U.S. corporate tax rate still exceeded the rate in many countries. Yeah, in some tax havens. Yeah, okay. Yeah, a lot of people like to put their corporations in other places so that they don't have to pay corporate tax. Uh, Still could produce substantial. No, no, no. Situating ownership of a profitable patent, for example, in a foreign subsidiary in a lower rate or no tax jurisdiction instead of the US still could produce substantial tax savings for multinational enterprise. Because of concerns that multinationals might seek to move profits abroad to include provisions, particularly the tax to discourage such. Is this just so that if you're a multinational and you're like a lazy fuck that doesn't want to deal with the taxation loophole stuff to pay no taxes if you're like international, you can pay this lower tax on your international income or your foreign income, and that would incentivize you to be like, okay, fine, this is low enough taxes. I'll just pay it instead of doing whatever I have to do to be in a tax haven. I'm assuming it's something like that. So then they still are willing to do business in certain areas, whereas they otherwise wouldn't because they're getting taxed too much. Like I don't understand. I don't understand what the incentive structure is for this. Okay. That's interesting. Oh my god. I need to learn so much more about tax code. Oh my god, there's so much going on. And like business taxes in general too. Okay, so yeah, they want to increase that to 21%. So basically, they're going to make that the same as what the previous corporate tax rate was. Okay. Calculate tax on a jurisdiction by jurisdiction based rate. Okay, gotcha. Repeal the reduced tax rate on foreign derived intangible income. I don't know what foreign derived intangible income is. Repeal the reduced tax rate. So yeah, this is like getting rid of the Trump era tax cut stuff, and but it's still not like as bad as it was beforehand. Maybe, well, at least it's not 35% corporate taxes. I don't know. Let's see. It's in the FDII deduction. C corporations with foreign derived intangible income can benefit from a 37.5% deduction. Jesus Christ. That's so high. Every C corporation that derives gross income from export activities should consider the foreign derived intangible income deduction. While the foreign derived intangible income deduction comes with a complex set of rules, it nonetheless represents a valuable tax base for corporations. Okay, so yeah, this was implemented under the Trump tax bill, where you could get this massive deduction if you did like foreign export shit, or how gross income from export activities. I don't know what that means. I don't know what export activities means. It's like export from the US to places, and then you could like I don't know how that works, but interesting. Okay, so that's major businesses. I don't know anything about like over half of these policies. Like I just don't. Oh my god. Let's see if I know anything about the individual stuff, because I am an employee. I make money. I have stocks. I get capital gains. Like okay, let's see. Uh, Expand the base of net investment income. tax, net investment income tax, to include non-passive business income. Non-passive business income. And increase rates of net income investment income tax and the additional Medicare tax to reach 5% on income above 400K. I don't know what we're talking about here. I do know what we're talking about here, where it's like, okay, if you make a lot of money, there's certain taxes that happen to your paycheck before you get paid, and Medicare is one of them. So then you'd be at 5% when you're at 400K or above for Medicare tax. But non-passive, expand the base of net income investment tax. I don't know what the net investment income tax is. Like, dude, like, what? What does this mean? What is the net investment income tax? Let's see. Net investment income tax is imposed by section blah in the IRS code, Internal Revenue Code. Applies at a rate of 3.8% to certain net investment income of individuals' estate. Net? What do you mean by my net investment income? Find out if does this apply to me? Let's see. I need to make 200K. What? If an individual has income from investments, the individual may be subject to net investment income tax. Effective individual taxpayers are liable. But are these thresholds just if I made this money from investments? Yeah, probably. I don't know what it meant by non-passive business. Non-passive business income. Okay, so they want to increase all this stuff to 5%. Right now it's 3.8% on your net investment. But I don't know what that, I don't know when this applies. Like, I just, okay. Increase top individual income tax to 39.6% on income above 400,000. So, income tax is already high for our top taxpayers. And oh my god, oh shoot, that sucks so much, because that means your tax rate 39.6% at 400,000. What's California's tax rate? Because California income tax, I've looked this up before, but they have the highest tax brackets. And because you could be paying like 60% taxes. No, not 60%. Okay. You're like 39 point. Okay, so you're just paying 40% taxes. Or you'd be at this 400,000 range. So, or we'd say let's say you're in this bracket. So 10%, yeah, you're basically paying 50% in taxes. Jeez. Or 49.9% in taxes. Because it was 10.3. Yeah, 49.9% in taxes. You're 50% of your income is in taxes if you're in California making 400. Damn, that sucks. You're going to, oh my god, you make 400,000 and you can only use 200,000 of that. Oh my god. Now, obviously, 200,000 is nothing to scoff at, but when your freaking houses are $1 million plus, okay, it's still not the worst thing in the world, because you can still do if you do 10% down. Wait, how much is, if you want to live in LA housing prices, because California, oh my god. Average home is $1 million. Yeah. So you can pay 10% down if you make two. Yeah. You're fine-ish, but my god, 50% kind of sucks. But you're comfortable. You're comfortable. If you make 200K a year, yeah, you're pretty comfortable. Let's see. Tax long-term capital gains and qualified dividends at ordinary income rates for taxable income above 1 million. Okay. Also, the thing that they didn't know, all these pundits and stuff, I didn't know this at all. When I saw the taxing of unrealized capital gains, I didn't know it was at death. So, one, it's at such a high margin where it above and tax unrealized capital gains at death above 5 million exemption, 10 million for joy. Like I don't think it's the worst thing in the world because they're literally dead. So then it's like, okay, they have all these assets. Now we're going to tax these assets when they die. Now, the issue might be that, if their assets are in a company, then, you've got a guy that's like owns a hell of a lot of the company. And then all of a sudden you're like, oh shit, this guy's going to die soon. Oh shit. What do we do? We're about to lose. We're about to lose all this money from this guy owning this chunk of the business. So that might be an issue for the business. But I don't know. There's probably something that's negative about that. But when I found out it was just like at death, I'm like, but nobody was going to use that money. I think. Maybe the business. Maybe Amedes. We'll see. Limit retirement account contribution. Oh, yeah. Long-term tax. How much did they want to increase long-term capital gains? Tax long-term capital gains and unqualified dividends. Tax for taxable income above. But what would they? Because we already. Oh, ordinary income rate. Okay. All right. Okay. So yeah, if you're at that 39.6%, because right now it's like 25% is the highest capital gains tax. Because it's way lower than income if your long-term capital gains tax. What are the brackets? Where are the brackets? Yeah, 0%, 15%, or 20%. And that's based on what income? Yeah. If you're in that 500K range, 400K range that they were talking about, you only have to pay 15% in taxes. Like, that's insane. It's beneficial to me, but yeah, I get it. And then 20% once you're about, and again, it doesn't apply till you're at 1 million. So right now it's like 20% for all those people, but then it'll be like doubled if it's taxes income. So yeah, I don't really have a problem with that. With higher capital gains tax like that. But what's it do? Like, does it ruin, like, according to this model, is that a bad thing? Let's see. Where is this? Unrealized capital gains and 39,000 jobs lost and 0.1% of GDP lowered. I just don't know. I want to know how this model works. Like, how I don't see this as a bad thing because it generates more revenue It could be the case that the argument is that our not highest income. I'll say highest income because a lot of them just don't make income. But anyway, our highest income earners use their monies in ways that's productive for the economy, that's more productive than the government would use that money. So that would be the argument there, where it's like, okay, this money would be used better if the individual is able to keep their money than if we tax them for being productive. And then, you could also say it's a disincentive structure where it's like, oh, I don't want to be as productive because I'm getting taxed more. I don't get as much of the money that I earn. So why would I do anything big? And then you have less of a tax base to go from in the first place because there's just less people being as ambitious because they know they're going to get taxed out of it. So I get that model too. So yeah, keep going. Let's see what else we got here. Limit retirement account contributions for high income taxpayers for large individual retirement account balances. What? That's a shitty policy. I don't like that at all. Why would you limit the retirement contributions someone can make just because they're higher income? Because I get it because if you're using an IRA, then you get tax cuts on that, or you can deduct that from your taxes. So if they can do a higher contribution, then that means they pay less in taxes. Or if they do it as post-tax income, like in a Roth, then at the end when they do retire, they're no longer getting taxed on that money that they're retired from. So then you're like, oh, we can't make money from that. But I'm like, I feel like you should be able to earn your retirement. Like if you did that, you should be able to like take the advantage. Like I don't I see that as annoying because like okay, so you're saying that I can't retire as well as I could have otherwise, or you could be like, oh, but the retirement accounts are just advantaging you from a tax perspective. So they would still be able to retire if you make a lot of money, and assuming you saved it and all that stuff, or saved/invested it, then you'd still be fine as a high income earner. But I don't know. That's kind of mean to me. But I see from a incentive structure of wanting to tax them more why that's the case. But this I don't know. It just seems mean. It's like, you don't get to take advantage of retirement stuff because you're rich. And I'm like, really? Uh, does that make sense? It seems unfair, but it might be better from like a fiscal standpoint. To be fair, I'd have to debate on that more. Let's see. Next, Titan rules related to the estate tax. I don't know anything about the estate tax. I just know that people that are that want to pass things off to their family have to do stuff, and there are loopholes around that, so then you can maintain your generational wealth or something like that. Let's see. Tax carried interest as ordinary income. I don't know what carried interest is. I really don't. As ordinary income for people earning. Okay, so yeah, they're just trying to make it so that more things can be taxed as income, as like normal income if you make too much money, because that's is that where most of the revenue comes from, the income tax? Let's see. U.S. tax revenue sources. Where do we make most of our money? Individual taxes. Corporate tax, they only make 6% from corporate taxes. Individual taxes are the most important. Yeah, okay. Social insurance tax, consumption taxes. Okay. Yeah, so they make most of their money from income tax. So because of that, they'd want to increase the amount of income tax that they get. That would increase the revenues. And then would they pay off the deficit that way? I don't know, but they'd have more money to support their stuff. Okay. Anyway. Okay. Yeah, reading this, like everything about reading this has made me like, I don't know shit about our tax system. Oh my god, there's so much to know. And most people will be like, oh, of course, nobody knows shit about the tax code. Like, I get it, but if you're gonna be voting on stuff, you should probably know something about how taxes work. But okay. Anyway, let's see. Limit 1031 like exchanges to 500K in gains. I don't know what 1031 is. 1031 exchanges. What is a 1031 exchange? What the hell? Like kind exchanges. Real estate. This is about real estate taxes? Oh, wait, the 1031. Oh, is that the thing where, wait, let me think. Section 1031. When you exchange a property used for business or held as an investment solely for other business, it's the same type or like, yeah, this is kind of like the thing where you can buy a property and then use the gains from the one property to buy the next property, but not be taxed on it, and then basically make it function as if that new property is the old property, because you're probably going to make more money on the new property when you finally make your capital gain. So then yeah, the incentive is to tax that more, or the incentive is that you would get more tax if you were able to invest it all in the next property, and then then the government would make more revenue from that exchange anyway. But this would be getting rid of that. Or oh, you can only do it up to 5,000 k, 500,000. Was the gain before? Okay. Anyway. So the gut feeling would be something like it feels like it'd be good in the short term to tax all these things, but long term you might be disincentivizing growth and that sort of thing, and then you end up with less GDP than you would have if you just like laid off the people, sort of thing. That's what I imagine the argument is if you're anti-tax increases, sort of thing. But yeah, because I don't know, does this get at the root of the issue? Because there's like, if you're following your like normal thing, because if you want to actually tax the billionaires don't make income, and they don't make capital gains either, because they just take loans out on their stock as collateralized loans. And because that's not a taxable event, then all they're doing is paying interest rates on that loan, which is significantly less than taxes. Like that's like single digit percentage, I'm pretty sure, on those loans. So that's how the billionaires are paying like nothing in taxes. And then they also have the schemes of their philanthropy work, which they take, what is it? When you do philanthropy work, you get like certain tax deductions and stuff because you're a nonprofit organization or whatever the fuck. And then that allows you to skirt your taxes more, if you do everything through that. So I feel like that's the place that you actually want to hit at if your goal is to tax some of these billionaires, I would say. But otherwise, I don't know. You're just, I don't know. I don't know. How much does the like 500K maker dude that pays their taxes normally, like how much is this gonna harm them and disincentivize them to do shit? I wonder. I don't know. But you know, your gut feeling if you're a leftist would be like, oh, it's good to tax the rich because the rich are paying the fair share. But we have to be sensible about this. Like, we have to like see like is this actually good tax policy? I have no clue. According to this tax foundation, they're like, no, this is bad. This is bad. Less GDP, lose jobs. But I don't know. I actually have no clue. So I need to know more about tax policy and stuff in order to, or not tax policy, economics, to understand how tax policy incentivizes or disincentivizes certain behaviors, and then go from there. So that's the goal. I don't know whether this video is going to be useful to anyone. It's long, and I didn't give any insight to anyone. So, yeah, I don't know. So, let's see. Like if you liked it, and dislike it if you dislike it. Leave a comment letting me know how stupid I am on the economics, because I just don't know. I just don't know how these things work. So, we're going to learn more. And then I'll watch this video in the future and I'll be like, my God, that guy was so dumb. He didn't know how the tax code worked. So dumb. But anyway, I'll see you all later. Bye.